Hello, welcome to the Grow Your Wealthy Mindset podcast.
Hello, and
where
welcome
it is
back
all
to the
about
Grow Your
helping
Wealthy
amazing
Mindset
physicians
podcast.
just like you create a wealthy
For many
life
of us,
free from
it's
burnout
tax
and
season.
with the financial
I know I've been
security
getting
to
a lot of
practice
tax
medicine on your own terms. I'm your host, Dr. Elisa
I know
John.
I have been getting a lot of tax reporting documents in my mail, things like W-2s and 1099s. I thought today we'd talk about the alternative minimum tax, or AMT. This may be something you haven't really heard about. It was originally implemented in 1969 to ensure all Americans paid their fair share of taxes. And it particularly targeted high-income individuals who were using a lot of tax deductions. The AMT was originally designed to tax high-income taxpayers who would use the regular tax system to pay little or no tax. Think of people who are extremely wealthy, who are able to find different loopholes in order to not pay tax. Warren Buffett has come out and said that he pays a larger percent. Warren Buffett has come out to talk about how he pays a much smaller percentage of tax on his income compared to his secretary. Unfortunately, because the alternative minimum tax was not indexed for inflation, a large number of taxpayers became subject to the AMT. The AMT started to affect taxpayers it was never intended to target, specifically middle-class households. The number of households owing AMT rose from 200,000. The number of households owing AMT rose from 200,000 in 1982 to 5.2 million people in 2017. To 5.2 million households in 2017. In 2012, Congress passed the American Tax Relief Act of 2000. Congress passed the American Tax Relief Act of 2012 that indexed the exemption amount to inflation to prevent middle-income taxpayers from owing AMT due to inflation and Congress passed the American Taxpayer Relief Act in 2012. And this indexed the exemption amount to inflation so as to prevent middle income taxpayers from owing AMT due to bracket creep. The Tax Cuts and Jobs Act of 2017 that was passed under President Trump's first term made much more significant changes to the AMT, beginning with the 2018 tax year, but that expire in 2025. If the TCJA does expire with without some sort of extension or renewal, the number of AMT taxpayers is expected to rise to 7 million households in 2026. With Trump back in office, I think we can expect to see some extension of some of the elements of the TCJA. If not, the alternative minimum tax may end up affecting many of us in 2026, which is what prompted me to think about doing this episode. The Tax Cuts and Jobs Act reduced a fraction of taxpayers who owed AMT from 3% in 2017 to just 0.1% in 2018. For people earning $200,000 to $500,000 of income a year, the percentage of those who were subject to the AMT fell from 27% to 0.4%. For earners in the $500,000 to $1 million range, the drop of those paying AMT went from 61.9% to 2%. Since this is the income range of many of us physicians, the AMT is something to pay attention to. Let's get inside how the AMT actually works. In the United States, we have a progressive tax system. Depending on how much we earn, we have to pay taxes on what we earn. However, the tax code is actually written to incentivize specific behavior. If you do the behavior Uncle Sam wants to encourage, then you can get a tax break or benefit. This leads to some high earners paying less taxes than those who earn a similar amount by using different tricks we often call tax loopholes. In order to plug these loopholes and ensure that high earners pay their share of taxes, the alternative minimum tax was created. An alternative minimum tax and alternative minimum taxable income, AMTI, is calculated by taking the ordinary income and adding back tax credits such as state and local tax deductions, interest on private activity, municipal bonds, the bargain element of incentive stock options, foreign tax credits, and home equity loan interest deductions. There are tax deductions, such as the mortgage home loan interest and charitable deductions, that are still allowed under the AMT. The AMT is then imposed on the AMTI at a rate of 26% or 28%, with a much higher exemption than the regular income tax. For 2024, the exemption was $85,700 for single filers and $133,300 for couples filing jointly. For 2024, the 26% rate applies to incomes up to the alternative minimum taxable income of $232,600 for all taxpayers. That breaks down to $116,300 for married couples filing separate returns. For 2024, the 26% rate applies to incomes up to the alternative minimum taxable income of $232,600 for all taxpayers, or $116,300 for married couples filing separate returns. The 28% rate applies to those who have incomes above $232,600. The 28% tax rate applies to those with alternative minimum taxable income above $232,600. A taxpayer who has a high income and uses large tax breaks may owe a smaller percentage under the standard rules. If so, the taxpayer is obligated to recalculate the taxes owed under the alternative minimum tax system, which eliminates some of those tax breaks. The taxpayer will owe whichever amount is higher. The AMT affects income earners typically between $200,000 and $1 million, which pretty much describes most physicians. Before the TCJA, it tended to affect people with high state and local tax deductions, high property taxes, people who exercise incentive stock options, and people who had large amounts of other tax deductions. W-2 earners in high tax states like California, New York, New Jersey, and Illinois were hit the hardest. For people living in these states, the TCJA capped the state and local income tax deduction, also known as the SALT deduction, to $10,000, but also raised AMT exemption limits and phase-out thresholds. If the TCJA expires, the AMT rules will revert to what they were before 2018, meaning lower AMT exemptions and lower phase-out thresholds. State and local tax deductions will fully return, and the $10,000 cap will be eliminated. But ironically, this actually makes the AMT worse because the large SALT deductions were not allowed under the AMT, so people living in high tax states will likely owe more under the AMT. If you deduct a lot of state and local taxes and property taxes, then the AMT could wipe out those deductions. If you have incentive stock options, AMT could make exercising them much more costly. Other deductions not allowed under the AMT include unreimbursed work expenses like licensing fees, travel, and CME. There is no deduction for tax preparation fees, investment fees, or financial advisor fees. Deductions allowed under the AMT include charitable contributions. You can deduct mortgage interest for loans used to buy, build, or improve your primary or secondary home, but home equity loan of interest is not deductible if the loan wasn't used for home improvements. You can also deduct contributions to tax advantage accounts like traditional 401ks, 403bs, and HSAs. Medical expenses over 7.5% of your adjusted gross income are still tax deductible under the AMT. Investment interest expense is deductible up to your net investment income. Gambling losses are also deductible up to gambling winnings. If you itemize deductions and live in an area with significant state, local, or property taxes, you have a moderate chance of paying the AMT if the TCJA expires. If you have incentive stock options, your chances are even higher. What can you do to prepare? If you have any large deductions that you can take in 2025, you may want to consider doing so. You may also consider bunching deductions, like prepaying property taxes in 2025 that would be owed in 2026, depending on your situation. Running an AMT projection and working closely with a CPA in your taxes, as well as keeping up with any changes or updates in tax law, can also help you prepare. This is where it's really important to have a CPA who helps with tax planning and doesn't just file your taxes based on what you did the prior year. This means meeting with a CPA or a tax professional throughout the year so that you can take actions to lower your tax burden. I have to say, that was not a fun episode. I do think one of the important things about podcasts is the ability to give timely information, especially for those of you who listen consistently. If you are one of my consistent listeners, thank you so much for your support. If you love this podcast, please recommend it to others. I'd love to get this knowledge out to more people. Thank you so much for being a listener of the Grow Your Wealthy Mindset podcast. And I'll be back next week with another episode of the Grow Your Wealthy Mindset podcast. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician. So if you need any medical advice, please contact your own physician. Thank you.